Nothing in detail, right?
Yes, sir. Nothing in detail.
Okay. Now, what I want to do is I want to go in depth, and uh, you will be able to notice in the Excel sheet what I have done is in the industry, specifically when it comes to jobs on finance, there are certain mix of options as well as the buying of the stock, which is always followed. And you have got several strategies. I have just highlighted like 18 strategies here. What I want us to do is, I want you to be very familiar with not only what these strategies mean, but you should also be able to calculate it. And once you have understood mathematically, okay, mathematically how we will be able to arrive at these results, everything else, okay, so all these things, once you have understood how to go about with these calculations, what I will be doing next is the notes that I have given you. This is the entire module, okay, on options which is there. And within this, what we have to know is when you come across options, how do you actually find out the premium price? Okay, the premium price will be decided based upon what, and how will they decide about it? And there are a couple of mathematical equations which are there, based upon which the option pricing is done, which is referred to as moneyness. One is, then you have got something called as lower bound as well as the upper bound for options, wherein you have got stock separately, currency option separately. And then I have given you in terms of option pricing models, which is referred to as binomial and Black-Scholes model. Now, this is the basis on which the option pricing is done. Okay, so if you come across the premium price, how do they actually decide upon the premium price? It will be always based upon what is called as the binomial option pricing model, as well as in terms of the Black-Scholes model, which depends upon some of the characteristics of the underlying asset. So I'll take this model which is there. Once we have gone through the Excel sheet, everything else. Okay. So what I want you guys to be very familiar with this, these Excel sheets. Okay. All my students, okay, when they complete their degree, when they go to the industry, uh, if one is pursuing in the area of finance only, one or the other way, this Excel sheet will be able to help you guys. Okay, so I want you to go through this, and if you have any doubts, then we can discuss it once more. But I want you to be very clear on the options, call options as well as put options. Very simple one. And as soon as I finish this, which we have discussed several times, when I come to this various strategies like synthetic call, covered call, everything else, you should be very familiar with first and foremost thing is these 4 sheets: long call, short call, long put as well as short put. How do we arrive at these numbers? You should be very specific. Once we know how to actually get it, and I have given you in terms of the videos also, now I wanted to take this forward, combining together not only one call option, that it might be like 3 call options, 2 put options, one buying of the stock. If you combine together, you will be able to notice at the end you come across some strategies which are referred to as butterfly. Okay, the butterfly strategies as well as bear put call. Okay, if you come across butterfly, you will be able to notice they do not only go for buying one call option or buying only one put option. What they do is simultaneously they will be able to buy 2 call options, 2 put options, buy the stock. So overall, by doing it, what is the overall impact? So that assessment is always done in the companies now. So whoever is the broker, when they are doing investments, when they are looking at their accounts, always remember that they will be not only looking at buying options separately, but they will combine buying of a stock, buying of the options all together, and then you will come up with what is referred to as options strategies. Okay, so when it comes to the option strategies, if you after your option pricing model, what I have done is I have separately had one chapter or a subsection which is referred to as options as well as exotic option strategies. These are the various options which are there. What I have tried to do is I have tried to cover these 18 or 19 option strategies which are there. The other to Condor as well as the Condor is the one I'll be able to send you once this class is over. So what we have to be able to do is we should be able to analyze these option strategies which are there. So first and foremost thing is just I'll take like 5 to 10 minutes briefing you on in terms of the long call, because I'll just tell you in terms of what these strategies are, show the same thing in Excel as well as do this problem once again. Once we have understood it, when we go to the option strategies, it becomes very, very easier. So at any point of time, do let me know. So when it comes to in terms of the option strategies, first one is we are when we go for buying of in terms of a share also, what we are now doing is, since I want to limit my losses, I am going for becoming buyer of the call option, which is referred to as long. Okay, so if a person is very bullish, that means they feel that the stock markets will go up in the future, what they will be able to do and in the future, and if at any point of time if the share prices goes down, they will be able to lose only the premium amount which is there, and thus this is referred to as in terms of the long call option strategy which is there. So let's take in terms of this problem, the same problem that we have discussed so far, but I want you to have a look at from a Excel point of view. So if I copy the same thing, the same problem which is there. So I felt doing the same thing in Paint will be much easier for me to show you all the aspects. So first and the foremost thing, what has been highlighted here is you will be able to notice that XYZ is bullish and the Nifty is at 4191. He tries to buy a call option which is available at 4,600. A premium is given as 36.35. If you are the buyer of the call option, a buyer has the right but no obligation. So he has to be able to pay the premium, and the seller, since he is obliged to do whatever the buyer says, he will be receiving 36.35. Okay. So if this is the case, what is the first step that we all discussed about is, first and foremost thing, this comes in very, very handy. Specifically when I'm going for combining a lot of aspects. So do let me know if you are finding difficulty anywhere. So if the given which is there, so here what they have said is you are the buyer of the call option. If you are the buyer of the call option, the strike price is also referred to as the exercise price. The price at which you are buying the call option is referred to as the strike price, and this is given as 4,600. And similarly, they have said the premium amount which is there, the premium amount is 36.35. This is what they have given. And then they say that the Nifty which is there is currently, okay, the Nifty which is there, currently it is trading at rupees 4191.10. And they have said the spot price in the future, which is there at the end of the contract, can be these values which are there. So I take so these are the spot prices which might exist during that period. So this will be another 5300. Now, if this is the case, all we did next was what I wanted to discuss here is from now onwards, you will be, you know, these terms that when we talk about buying in terms of the options, when you go for option strategies, one thing that you should be able to understand here is if I take the same question here, and here the exercise price which is there, the exercise price is given as 4,600. Okay, so exercise price is given as 4,600, but you will be able to notice that the spot price which is there, this nifty spot price that is currently when you are going for purchasing, that is around, this is 4191.10. Okay, and you will be going for exercise price plus in terms of the premium amount. This is the spot price. Now you will be able to notice that when you go for buying in terms of a call option, this is the call option. When you go for buying the call option, if the spot price is greater than the exercise price plus premium, you will be able to notice that here what happens is if the spot price is greater than the exercise price, you will be referring to this term as what is called as in the money, ITM. Okay, so which means when you enter into a contract only, you start making in terms of a profits. But here you will be able to notice the spot price which is there is 4191.10. That means why you are going for a call option is you are assuming that this spot price of Nifty which is there slowly will go above 4,600 and it will cross even the exercise price plus premium of 4636.36. It will go above 4636.35 and you will be making more profits. Okay, so why do people always go for the call option is for the reason that they believe that this is referred to as what? This is now referred to as OTM. That means it is out of the money, okay, contract to start with, and you have a belief that this 4191.10 will cross 4636.36 and it will go further within the period of each contract will be for 3 months contract, so it will go beyond it. Since you believe that, you are going for what is called as a call option, and since you want to limit your losses, you are limiting your losses to an extent of 36.36 only. Okay, so this is what we have learned. Now once you have this, well, the second step that we followed here is I should be able to go for what is called as the payoff diagram for the buyer of call option. Okay, so this is for the buyer of the call option which is there. So if this is the case, what we now decided also is if I have to come up with the payoff diagram similar to what we had drawn before also. Here you have got, this is the payoff diagram, this is profit, this is losses, this is no gain or no loss, and the spot, the exercise price which is there is given as, and this is your exercise price plus in terms of the premium amount. So this amount turns out to be 4,600 and the exercise price plus premium turns out to be 4636.36. So this is okay. So what we do is if I want to come up with this diagram, first and foremost I should be able to say the premium amount of 36.36 has been paid by the buyer. So his minimum losses which will be there will be to an extent of 4,600 plus, since he has paid a extra amount of 36.36, his break-even point, the break-even point will be 4636.36. So if I make if the spot price is greater than your exercise price plus the premium, that will be your profits which are there. But what you will do is, whether you will exercise the option or not always depends upon your exercise price. So spot price, if it is greater than exercise price, you will always exercise the options, or otherwise you will not exercise the options. So if that is the case, they have given you in terms of these values which are there, 4100, then you have got 4300, this is 4500. So here, just take it. Okay, this is all right. So 4636. So 4500, then 4636.35, then it is 4700, then this is 4900, and this is 5100. Okay, this is the values which have been given. So what we agreed upon is, if you all go to this long call problem, okay, so what I have done is, whatever is the notes which has been given here, for this problem on the long call option which is there, I have tried to do the same thing in this Excel sheet. Okay, so if I want to do it on my own, what you can do is, you can right click, you can go to move or copy, so that you will be able to create a copy of itself. I want to create a copy just after this long call problem. I'll say okay. So you will be able to notice that if you are doing on your own, okay, so this answer exists already. You can go to the copy that you have. You can delete the contents which are there. And then what we had done previously also is, once you have got in terms of this diagram which is there, what I'll do is, I'll just take okay, so I will take the payoff diagram which is there. Now using in terms of the payoff diagram, I should be able to come with the calculation. So here I'll just copy and paste somewhere here. Okay, so if that is the case, what we said here is, if the spot price is lesser than the exercise price, he will not exercise. Okay, so he will be losing, maximum is 36.36. so what we'll do is, if I want to know at this point what is the value, since 4100 is lesser than 4600, the maximum loss for the buyer of the call option will be nothing but negative 36.35. The same thing when it comes to 4300, it is the same thing, negative 36.35. The same thing with respect to 4500, it is negative 36.35. When you come to 4636.36, this is our break-even point. Since it is our break-even point, here you will have exactly equivalent to 0. And now, since 4700 is greater than our break-even point, but all of you have to understand that the option to exercise or not depends upon this 4600. So if 4700 is greater than 4600, he will definitely go for exercising. And so after your break-even point, whatever is the amount, that is nothing but is your profits. So if this is the case, if you take in terms of 4,700, which is there, now the 4,700 you will have in terms of how much will you have? You will have this as 63.65. Then this will be nothing but 263.65. This will be 463.65. And the same thing in terms of 663.65. Okay, so our break-even point here was nothing but 4636.36. So if you have got these values which are there, you will be at the end, once you have got it, what we'll do is just maximize this. So once you have got this, if you have gone through the video that I had sent, you will be able to notice that if I have got the break-even point which is there, the break-even point was nothing but 4600. This was 1 plus 36.35. We got the value as in terms of 4636.35. So once you have got these values which are there, what we now decided is we said if the spot price which is there, if the spot price is greater than exercise price, then you will be always saying that we will be able to make some profit which is there. So what we did here also is equals to if. First and foremost, what I'll do is I will take, just a minute. I'll go back to this. I'll just copy this. Okay, so here you will be now be able to notice that if the value which is there, if it is greater than, if the spot price is greater than, what we'll do is spot price minus in terms of the exercise price plus the premium. So equals to if, we will always consider the positive side or the profits first, and then we'll go for the premium amount. So if that is the case, if the spot price is greater than the exercise price plus the premium, I'll take the constant values later. So if that is the case, what we have to do is the value of spot price minus the exercise price plus premium will be nothing but in terms of the profits. So, and later on what we'll do is we will say specifically when it comes to options, you will be able to notice what if the value which is there, spot price, falls within this range. If it falls within this range, we will be able to notice if it is 4,600 exactly, he will incur 36.36. But if it is 4,601, what happens is the amount of premium that he has paid drastically starts reducing. So what happens here is he will exercise the option. That means the amount of losses that he will have will be much lesser. So if that is the case, what I want is if the spot price which is there is greater than 4,600 and if it is lesser than 4636.36, I should be able to subtract this value which is there, okay, from 4636.36. Okay, that will be able to give us in terms of how much is the losses which are there. So what I'll do is if the spot price which is there, if it is greater than 4,600, and then I'll say if the spot price which is there is lesser than or equal, I'll tell you later. So 4636, which is nothing but our break-even point. If it is less than, then what we'll do is, if the value, if it is true, I will be able to take, if I do 4636.36 minus any value which comes in between, you will be able to notice you always get in terms of the positive values. Okay, so what we are now saying is we should be able to get some negative values here. So what I'll do is I can take spot price minus in terms of the break-even point of 4636.36, and then comma, if it is now found to be not between this range, not greater than the break-even point, if it falls somewhere in this range, I should be able to lose a premium amount of 36.36 because I will not exercise the option at all. So the last one is minus 36.36. If I have it, and here I need to have in terms of, this is constant, so function F4. This will be function F4. This is function F4, and this is function F4. So now we will be able to notice that first one will be 36.36. Then you will be able to notice that if, since it is lesser than, we'll still be able to make a loss of 36.36 only. Then you will be able to notice that if it is 4,500, it is still lesser than. So when it comes to 4636.35, this you will be able to notice it is still giving you as my negative 36.36, but you should be able to get this value which is there as equivalent to 0. And then if I go for 4,700, it calculates correctly as 4,700 minus 4636.35, which means when I go for this formula, you will be able to notice, since it is coming as lesser than, I should be able to take it as lesser than or equal to the 4636.35. Then it should be able to calculate this, or otherwise it should go for 36.36. So if I now go up till here, you will be able to notice it will give me as 0 because I am considering it as equal to. And then if I go further, it is 266, it is 463, and then it is 663. So this is what is referred to as in terms of the buyer of the call option. And if it is in terms of the buyer of the call option, you will be able to notice the same thing if I do it in exact reverse way, though you have got another problem which is there on short call option. What I want you guys to do is, if I have taken different problems here. Okay, so this is one problem which is there on long call option strategy which is there. When you come to short call strategy, the problem which is there is completely different. But what you have to be able to do is, if you have calculated this for the buyer, do the same thing for in terms of the seller of the long call option also. So if I want to make slight changes here, wherein I will say this is the net payoff from the seller of the call option, you will be able to notice the only change that will be able to happen here is nothing but if he loses 36.35, he should be able to, the seller should be able to make a gains of maximum gains of 36.36. And in terms of up till the break-even point, he will be able to notice that this will be 0 only. But when the buyer will start making profits, symmetric losses will also be done by in terms of the seller. So if that is the case, if I want to come up with that, equals to, if all I want to have is what? First, I will always take from a perspective of, here, I'll first always take in terms of the perspective of the seller, but a spot price to be greater than. Okay. So if that is the case, the same formula which is there, but in this formula slight changes will be made. What will be the slight changes is, if you go back, if I'm looking at this problem, all I should be able to consider here is, this is my gains, whatever is the loss here, whatever is the loss negative, this should be my profits. So this will be 36.36. This will be the maximum gains that the seller of the call options will have. So if that is the case, I'll join exactly here, and then this will be the exact symmetric losses which the seller will be able to have. So if the spot price is greater than in terms of the exercise price, you will be able to notice, if buyer makes profit, he will be able to make in terms of losses. So let's go back just to do this problem. So equals to, if the spot price which is there, if it is greater than the break-even point, okay. So previously what we had considered is 4,700. This is 4,700 minus 4,636, which will always lead to gains. But here we will have the losses. So we will have it as the spot price minus the 4,636. The value that you get will be positive. I'm just having the converting that into negative value. And then if, and now we are saying if the value is in between, okay, but we know that if it is equal to 4600, we will be able to make a profit of 36.35. If it is anywhere in between, the losses for the buyer will start decreasing. The gains that you have will also start decreasing from the seller of the call option. So if that is the case, if and the spot price which is there, if it is greater than, same formula, if it is greater than 4,600, which is our exercise price, comma, if this spot price which is there is less than or equal to the break-even point of 4636.36, if that is the case, then you will be able to notice that what is that we have to do now is, if the spot price which is there, if it is in between 4600 and 4636.35, we should be able to get in terms of a negative value. So if I have to get in terms of a negative value, the spot price which is there, the spot price minus 4636.35. So the spot price which is there minus 4636.35, that will that should be able to give you. So if this is 4,630, for example, so 4,630 minus 4,636.36 will result in you will be able to notice negative 6.35 or 36, and then comma, if everything, if all the values fall on the left side, okay, or the spot price is lesser than 4,600, then you will be able to notice that you make maximum gains of 36.36. So if that is the case, this is 4636.36. So if this is the case, you will be able to notice that this will take in terms of constant function of 4. So what happens here is, if I take this, I'll just add another one. So here 36.36, this is 36, this is almost closer to 0, and then the losses which is there will be exactly symmetrical in nature. So this is for The seller of the call option, this is nothing but for the buyer of the call option. So you will be able to understand this concept.